Hello, everybody, and thank you again. Moving on to the fifth and last section of the update. It's almost like bonus material based on extraordinary circumstances in the last few weeks. And indeed, we've gone through a period of extreme volatility, perhaps since 2008. In my view, in some aspects, even more hostile than 2008 in some fronts. And in this environment, what we've seen is, how many assets have suffered significantly. All the time, why, hey Diego, why is gold down? Is that when implied and realized volatility are in the 40s or 50s, or high, whole process goes into deleveraging and forced liquidation. So you have this process that I've described many times, and I had in a Twitter recently, where it goes from artificially low levels to higher levels, and as volatility increases, your value of risk increases. This can result in forced liquidation, which can, as everybody has the same positions, can start impacting liquidity. And as volatility increases, we see relations increasing, which effectively has a compounded or exponential effect in value at risk, which leads in turn into more liquidation and effectively a process that can spin out of control. Eventually, you have these major dislocations, and then what we've seen invariably is a bigger response from central banks and governments, as we discussed earlier, and assets like gold that might be down short term, they end up being much higher long term. And so I think as we see through what happened during this year, we saw volatility picking up in February, but then really going very, very distorted in March. And I would highlight that period in red, where this is certainly, I don't remember a period where U.S. Treasuries, long-dated U.S. Treasuries, collapsed in this manner in a hostile market with such aggressive intervention from the Fed and money printing. So truly extraordinary, which to be honest makes us even more proud of the strong performance that we generated. And again, we haven't done it by luck. It's something we've done by design, and we're going to zoom into how and why we did this and how we're likely to continue to do it again. The first point is very important, is we don't have any leverage. What you see here is pretty extraordinary, but we've added the brown line, which is gold equities, and in particular is an ETF that is 3 times leveraged. What it does is every day it buys and sells so that you have 3 times exposure to the market. And I was pretty shocked on the silver. That's the case, and it's in the prospectus. I don't think people realize that when you have a big volatility move up and down, or down and up, this is basically game over. Because if you are 3 times levered and you ever had a 30% move, that means you lose 90% that day, which means your $10, even if you invested in 30, will never ever recover. And this is really what you see, and it's extraordinary, because they actually have a negative compounded effect on the way down, and then investors are really just, it's a permanent loss of capital. So this is just it's something that investors thought, oh, in a crisis, as long as possible in gold or gold miners, you see how the leverage actually completely wipes you out. And if you run the numbers, you would see this is very likely to happen. So key point number 1 is no leverage. The second point is long-only options. And point before many times, I've seen people with $1 million. You see people saying, oh, I want to short Tesla and I'm going to buy puts and I'm going to finance them by selling calls. And I would say, you're not financing anything. You're long puts and you're short calls, and just blow up. In that sense, a lot of long shorts, a lot of value strategies that use long shorts and buy and sell options. So in that sense, whilst people tend to worry, oh, you only buy options, oh my God, how much are you spending? How much are you bleeding? The reality is that we are the most conservative strategy because we know with 100% certainty what our limited downside is, which is the premium. And in our case, we look to buy options that are artificial wherever we can, and with very explosive payouts. So in fact, is a very conservative approach. The third is the ability to be very diversified, both in terms of puts on risk assets, calls on anti-crisis or anti-bubbles, and not only in terms of the nature of the put and call, but also through time, through underliers, and in terms of payoffs. So what it means is that during this crisis, there's been times where perhaps gold was getting hit, but the dollar was up, or we had equities going down and the VIX going up, and things that they may have not all of them been paying at exactly the same time. In fact, it's given us an opportunity to the next point, which is we have a very disciplined profit-taking process, which means that we keep a fairly smooth risk profile. So, the amount of money we have at risk, that 20-25% in premium, when the markets go distressed, might be worth 30, 35, 40, 45. So we're effectively actively taking profits to bring the risk back. And this is a very strong position to be in. And it ensures that that money that is being disciplinedly basically monetized is treated as capital. So we effectively reinvest back into the core gold and treasuries, and a portion of that into insurance. And this is critical, and is the fifth point, because ultimately that reinvestment is something that we're constantly looking for the next 10 to 1. And when the market might be obsessed and focused on the VIX, we've already moved on and focused on opportunities that might be giving us the next 10 to 1. And that's something I've discussed with quite a bit of detail in a presentation, and where we feel very strongly that we are well positioned to continue to deliver these hopefully big numbers. So in that sense, again, your portfolio is your team, you're the coach, focused on the long term, focused on not only scoring goals, but also on capital preservation. I think that the strikers in this environment should be heavily, I have a strong preference for equities versus credit, which I think, given inflation is the end game, will suffer over the longer term. I think real assets there to play a strong role. Be very mindful of cash and bonds in general in this over the medium long term because of inflation. But also be mindful of or aware at least that the treasuries and bonds and in general are going to have limited room, and therefore we need to put even more emphasis in building defense and goalkeepers that are reliable. You've heard me before, you're not as good as your last trade, as they say in the industry. You're really as good as your last crisis. So this new match is only started. I think it's going to be a bumpy road. There's tremendous opportunities, tremendous risks. And I want to thank you all for your support. And I look forward to much success together. So lots of health to everybody, and speak soon.